Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of Retail Focus with Trent and Leighton Kling. Coming up on this week's episode, the Tile Shop reports earnings. We talk two retail IPOs and the numbers in the lead-ups. And a regional grocer strikes not one, but two last-mile partnerships. Our interview guest this week is Sylvain Perrier of Mercatus, who discusses e-commerce execution of regional grocers and also the takeaways he has from the Digital Food and Beverage Conference he was at this week in Chicago. But first, Leighton, we're a retail podcast. We would be remiss if we didn't mention Prime Day, but it does feel like Groundhog Day a little bit for us. In the years that we've covered Prime Day, the headlines this year are the exact same. They set more sales records, the website went down, and other retailers responded with deals of their own.
They had $4.2 billion in sales, according to analyst estimates. Although this did last 6 more hours than in 2017, you saw a lot of promotional materials from Amazon touting that very fact that it was over 24 hours in promotions. But over 100 million Prime members participated, or at least that's how many are on the platform that were available to participate. Amazon shipped more than 100 million products in the first 24 hours. Other e-commerce retailers had deals, as did brick-and-mortar retailers, and they tried to compete against Amazon Prime Day, or at least take advantage of all of that e-commerce traffic. Kroger released a cheeky response to Prime Day, saying that they'll sell an average of 110 million items at their stores on an average day, basically saying that they already do massive amounts of business. The website did again have issues. Prime Day fail once again trended on social media. You can see it on Twitter and Instagram, hashtag Prime Day fail. This time, the landing page for Prime Day didn't work at the start of Prime Day. Also, some reported a slow page response for some of the most well sought after featured products. And Trent, I think this really speaks to the amount of traffic that they had, but also maybe they weren't necessarily ready for all of that traffic. And this is something that Amazon is known for with AWS, helping other e-commerce retailers in this particular spot, but they really need to be able to fix this for next year if they were to really extract all of the potential sales that are out there.
And we won't know exactly how many sales they lost from this. I would wager that it's not a ton, certainly, but they're leaving revenue on the floor the more their site doesn't work for an event like Prime Day. So now that we've gotten the obligatory Prime Day coverage, I'm sorry, but there's really not a ton different this year over last year, other than the volume was certainly up. The impact on other retailers was certainly up as well. So let's get to our main story, which is the Tile Shop. After experiencing all-time lows as a stock back in February and March of this year, the Tile Shop absolutely surged on Thursday after a positive quarterly report. This is a report that Leighton and I were both looking forward to for some time now. After we saw the Tile Shop dip back in February and March, their stock has remained somewhat depressed. We were looking at this to see if the Tile Shop, with all these renovations they've had going on in their stores, would be able to bounce back from some rougher quarters. If you're not initiated to the Tile Shop, they're founded in 1985. They've expanded a lot more aggressively throughout the last decade. And in fact, 2-3 years ago, they were the darlings of the retail world on the stock market. They sell not only tile, but drain accessories as well, adhesives, and tools for proper installation. They also have contractor services, which is an ever-growing segment with home improvement retailers, not only niche retailers like the Tile Shop, but also the giants like Home Depot. The Tile Shop has been smart to expand their product selection and add different subcategories over the years as well. But a downside is that their website still only serves as more of a catalog, wherein you can really only browse or schedule an in-person consultation or create project layouts and order only samples for certain projects. It's not necessarily a full omni-channel capable website. And also, in our opinion, it lacks proper merchandising a little bit of the products. The company, however, does use their showrooms very well, again, in our opinion. And their showrooms are their main way to promote their new designs and features of their tile, whether it's glass, stone, porcelain, or metal. And despite having a larger showroom presence and arguably more overall industry demand, their physical locations did lack strong sales this quarter, but they were able to make up for it in other means.
Same-store sales for the retailer were down 1.8%. a modest figure, a figure that we thought would come in more in the neutral category. But if you look at their previous quarter, as Trent had alluded to, a lot of struggles in terms of same-store sales. Last quarter, the first quarter for the tile shop, came in at negative 6.8%. So definitely a rebound from that particular number. And if you look at a CEO update, they said that during their second quarter, they continued to improve their assortment and grow their pro customer base. Again, the pro customer is something they've been focused on more and more recently. They said they also improved their store experience through the combination of their store remodels and merchandising investments, really speaking to all that Trent just said. But it looks as though it is, in fact, coming out and working for them. One could argue that they've been able to get the sourcing part of their business even more correct, at least in terms of the cost of goods perspective, because guess what, Trent? Gross margins improved during the quarter to a whopping 70.3% of sales. So not only are the people liking their product selection, they are buying the products in which they sell to the customer at a much better price point. Adjusted EBITDA for the company, however, did fall to 16.2% of sales from over 21% last year. But again, a lot of one-time costs associated with this retailer having all of those remodels. So far, numbers-wise, it looks as though the company's stock should have fallen. So now we look at why the analyst comparisons for top-line revenue and earnings per share ended up boosting the stock in double-digit territory. The company beat average analyst estimates for earnings per share by over 20%, with adjusted earnings per share hitting 10 cents. Total revenue of $92.9 million beat estimates by about $2.5 million, so a modest beat there. This was indicative of a 3.9% increase year over year, again, on the back of new locations. And that's because they ended up having those falling same-store sales. They had to get that tick up in top-line revenue from somewhere.
So their interim CEO, Bob Rucker, was on their earnings call. And again, we sit on these earnings calls so that you don't have to. We can kind of weed through some of the chaff. And his message was that they wanted to market more to upscale customers. They wanted to increase the size of ticket. And also there was more of a focus on service. Service was mentioned a lot during the earnings call, which can certainly differentiate their business from one like Home Depot or Lowe's, where you're dealing with a big box store that isn't quite as specialized towards products like tile. Notice the interim status that we mentioned for Bob Rucker. They are looking for in-house leaders at the time. They mentioned a strong succession plan stemming from the goals of moving ahead without a full-time leader. And in fact, their COO on the call highlighted the importance of more tile selections. COO, one would think, certainly part of that strong succession plan. But in terms of larger tile selections, one of the things that they've tried to do is clear out some stale selections and aggressively bring in a lot of new and fresh designs. They actually had a product assortment peak back in 2015. And if you recall back at that time in 2015, that was the period of time where the tile shop was really doing well. Their stock was surging, it seemed like, on every single quarterly report. Well, it went down again in 2017 and in the early portion of this year, but recently they've managed to exceed their product assortment peak, and this time they feel like they're doing it in a sustainable way. An obvious reversal in strategy here, and we think it's something that's going to help the company long term. Again, not everyone is looking for the same product. We've seen this same approach work with other niche home improvement retailers like Lumber Liquidators and Sherwin-Williams, for example. So combined with better service for the pro customer and the layperson, they do see strong revenues for the remainder of 2018 as they look to capitalize on that increased product assortment and increased inventory. Now, as it pertains to their brick and mortar locations, they've recently revamped 3 older locations to include more digital tools. Not only that, they've gone through with new stylish fixtures in the stores to exemplify their new tile selection. You've got brighter lights, more LED lighting systems in the stores, and a better internal merchandising system as well. These revamps are something that they have been going through over the last year to year and a half, and they seek to do more a little bit in the future, but they are somewhat unsure, they said on the call, about CapEx or capital expenditures for 2019. Ultimately, though, they do want a more extensive refresh in their store portfolio. Again, in-store is where they're collecting their customers by and large, and that's where they're able to upsell their customers, whether that's pushing them from a cheaper version of tile to a more expensive version of tile with a greater markup, or maybe selling them on doing tile for more than one room in their house. And as a result, the store look is so important to this company. That really bled through on the earnings call and during the analyst Q&A, and that's one thing that they're going to focus on going forward.
We mentioned service quality and appeasing a higher end consumer. One way to do that is to have even better store training for your personnel or compensation plans for those sales associates. Obviously, you want to be able to focus on the better performing sales associates and keep them working for you. And that's no different for the tile shop, as it looks like they are intent on doing the latter with additional regional management support to boot. They cited a tighter labor market where they have been losing a good amount of employees to competitors, obviously not just competitors, but probably to other industries as well. But they think that the in-store service dynamic is currently healthy, both with morale and the level of staff per store. So their staffing levels are adequate and the employees are a bit more happy with the compensation plans. They have separated the pro-business market managers as well, a notable difference for the company's internal workings. They noted differences in their website, such as removing regional pricing tools. In their view, as long as the website is easy to navigate and access, people will be led into the stores to make their final purchases. In our view, there is still much to be desired from the website, and we would like to see pricing available per zip code like with their competitors. That is a modern feature that we think is extremely important, especially if you're trying to align your projects. They do have project tools on their website that is extremely helpful, but if you have a budget, it's important to know how much you're going to spend if you have different projects. Visual online merchandising needs to be stepped up, again, in our opinion, but their site is fairly easy to manage if you want to get an idea, at least a base idea of their product selection and brand portfolio overall. We look at the stock and how it's performed. Like we said, recent all-time lows in just this last year. Shares, ticker TTS, were up by double digits, around 12%, like we said on Thursday, but fell in Friday's trading by over 5% to close back down to around $8.80 a share. 52-week highs for the company around $16, 52-week lows for the company around $5 a share. Right now, Trent, they're sort of in that sweet spot, that middle ground. I think that they have some room to run if, in fact, all of their promotions and their in-store merchandising efforts end up working out for the long term. We move on and we take a review of the most successful retail IPO in 2018 with BJ's Wholesale, and also look how Albertsons is doing with their Rite Aid acquisition after deciding this year to not go through with their own IPO back in April. Shares of the warehouse club operator have jumped more than 50% from the June 27th IPO date, which is priced at the top of the deal's $15 to $17 price range. They ended up issuing shares for $17. They saw the demand. They took advantage of it to extract all the necessary capital that they could. This has caused increased scrutiny within the company, leading some to believe that perhaps right now the company is overvalued given that 50% jump up in share value. BJ's Wholesale does have over $2 billion in debt, but will reportedly pay a large chunk of that off with the proceeds, which total about $637 million. Again, it was a little bit more than expected because they were able to have those shares at $17 for those first investors. And by the way, Trent, those investors, a lot more scrutiny over the coming days for those first underwriting banks.
So these underwriters, or really just the major banks such as Bank of America, JP Morgan, and Goldman Sachs, have a 30-day option to review and buy up over 5.6 million more shares of common stock, which is yet another reason why the company has been the center of this valuation discussion. Now, reasons for the shares going up are pretty straightforward. There have been few high-profile IPOs this year and even less from the retail sector. We're talking about two in this very story. Compound that with the somewhat inelastic membership price that is going up and solid same-store sales from BJ's, it made sense that the shares have been in an upward trajectory in the last 3 weeks. But as someone who's talked about BJ's on the show before, Leighton and I both know that you've got a little bit of a limited expansion window if you are BJ's, simply because of the region that you're in and because Costco continues to just surge forward in this membership club space. Now, we have to remember that this company, BJ's that is, has had its share of highs and lows. They were publicly traded for a short time prior to September 2011, when Leonard Green and Partners and CVS Capital Partners paid $2.8 billion to take the company private. The reason we reference that is because the private equity firms didn't manage to grow the company too much in the 7 years. If you look at their market cap or their perceived market cap now, they had 190 clubs in 2011, just 215 right now, which is a small growth rate, 60% of those having fuel stations. And I say that's a small growth rate. In those 7 years, you look at how the other membership clubs, even with Sam's Club, closing stores more recently, chain like Costco growing a lot more quickly than that and adding more stores than that. Now, BJ's does have a presence in 16 states, up only one during this time frame, that time frame from 2011, most of those on the East Coast. Net income for 2017 for the company was $50.3 billion, up from 2016's figures. Their current market cap sits at about $3.4 billion. So it is a little bit of an improvement over that $2.8 billion they paid to take the company private. That's assuming a $25 share price, not representing a huge return, but it is a return nonetheless for the original investors if we strictly look at capital gains. However, if we look at a stock index just overall, we can see larger increases usually in market caps over that time than what we've seen, at least from BJ's. And this current market cap, we should mention, is with a price to earnings ratio of 68 times trailing earnings, which is an immense valuation, one that's even larger than the price to earnings ratio that Costco currently holds, which is around 34 times. And we see more growth prospects for Costco than BJ's, and it's not really even close, especially with Costco's same-store sales and their proven ability to continuously and sustainably expand.
BJ's Wholesale may rise yet again in terms of share price on Monday if analysts surprise the market with bullish outlooks, but a cautious approach from Wall Street could weigh on shares and hurt their ability to secure more capital from banks, as Trent had alluded to. They have options for over 5.6 million more shares if they end up coming back with positive remarks about the institution, but they're looking to buy more shares, and if they don't, that could suppress shares because the current shareholders may think that their shares are indeed overvalued. Albertsons is reportedly trying to convince their investor base to accept the Rite Aid acquisition that would give the company a combined $24 billion in annual sales. Unlike with BJ's, they canceled their IPO back in April in favor of focusing their efforts on growing as a private equity with the stores Rite Aid has left from the Walgreens integration that just finished earlier this year. Rite Aid and Albertsons shareholders have been skeptical on the deal because Albertsons has had their own struggles as of late, and some question Rite Aid's performance in their remaining store base. They had sold around 1,900 stores to Walgreens, some being in the higher performing locations, the higher performing areas of the country, so some are worried about the remaining locations that Rite Aid has and how much they would really actually bring to the bottom line of Albertsons. Shares, by the way, have fallen over 20% for the still publicly traded Rite Aid since late February, when the rumblings became a bit stronger from management for the potential merger. A gentleman, an individual shareholder from Los Angeles with about 1.5 million Rite Aid shares, has recently told the media that he and several other larger shareholders want this merger stopped. Some, not all of the concerns had to do with Albertsons' performance as of late, which has concluded several quarters of flagging same-store sales.
To that point, though, they issued their first quarter earnings earlier this week. And by the way, full disclosure, before we get any further in this story, I am a Rite Aid shareholder. I sold off a lot of my shares months ago, but still hung on to a few hundred shares going into the summer. Same-store sales for Albertsons were trending in a positive direction, finally, with an increase of 0.2%. Now, that's still a bit behind inflation, particularly for food, but at least it puts a stop to their negative numbers they'd been seeing up a lot in the last fiscal year. Perhaps even better, though, for potential investors or for Rite Aid shareholders like myself, who may eventually become Albertsons shareholders, they've reaffirmed seeing 1.5% to 2.0% same-store sales growth in fiscal 2018 as a whole. Now, again, only one quarter in, but this indicates some strong sales at the beginning of their second quarter, and that would also significantly outpace last year's performance. Excluding fuel, their gross margin also increased 60 basis points, and new store openings and or conversions added $44.1 million to their EBITDA, which was an increase of 5.7% over 2017's first quarter. Finally, store conversions and integrations are nearing the end after the Safeway merger. They're slated to be completed in September of 2018, just in time for potential action to be taken in terms of this Rite Aid deal if they do end up converting their in-store pharmacies to Rite Aid locations, which they've suggested they would do in the past. And in turn, because the Safeway conversions are just about done, that means less capital outlay in that particular area, meaning it could free up some capital to go ahead and convert some pharmacies in stores or work on that merger with Rite Aid. Now, management has told shareholders on both sides through an information campaign that pharmacy sales could be bolstered through the merger and that the combined company could create over $370 million in cost savings. And honestly, there are some shareholders, as Leighton mentioned, that seem to be disagreeing with this deal. I don't think it's that tough to see where the cost savings would be coming from, but I think the bigger part of this deal is, A, if you're a Rite Aid shareholder, you're probably not going to get anything better on the table, and B, this opens up a massive possibility for Rite Aid. We talk about that CVS deal they brokered with Target, pushing Caremark into all of the Targets throughout the country that did have pharmacies. I think this deal is going to offer some of the same benefits where Albertsons may be able to offer in-store clinics as well in a lot of their Albertsons, Safeway, and other locations under their banners. So I see a big benefit to this, especially at the conversion rate, which is a tenth of an Albertsons share plus about 18 cents for every Rite Aid share Rite Aid shareholders own.
I would absolutely agree that this is probably going to be a good deal for shareholders in the long term. It's definitely a good deal for the company in the long term, I believe. However, if I were to take the side of the current investors, especially on the Rite Aid side, it is unclear where those proposed cost savings would come from. A lot of analysts had said potentially over $400 million in cost savings. And some are saying, well, they haven't been too transparent as to where all these big numbers are coming from. Albertsons management is just throwing about numbers, trying to get the deal done, trying to get all of the convincing work done with all of this promotional material. But there's not a lot of detail in the numbers. And I think that is going to be a problem. Again, if I were to be a shareholder currently, which I am not, I think for the long term, it's a little bit more muddled to see the vision as something that is clearly stated and to really see a runway for growth in the future. Albertsons did say they would invest more in technology, but that is something that they have already started to do a little bit more aggressively. Something, in fact, we talked about last year on this very podcast. With or without Rite Aid coming on board, this is something that they've already actually been doing. So to say that we're going to integrate Rite Aid and because of that, we're going to invest in more technology, I think that's a total side argument. That's something that's totally unrelated to the performance of this proposed merger. The one argument we could make is to say that they would have a larger distribution presence. That's going to be a fact. I mean, that's just an objective way of looking at this, and that they have a larger geographical footprint if this were to come to fruition. They could presumably shut down some distribution networks with Rite Aid, and they could, to Albertsons' point, have more buying power to then drive down the cost of goods sold to be more in line with the Walmarts of the United States. After all, they are competing with the Walmarts, the Targets, and the Krogers in the U.S. So to have that additional buying power, to have that additional customer on board with Rite Aid, I think is extremely important from the buying side. But again, it's all up to the shareholders here. The people in power are the shareholders and major executives of these companies, and I'm very curious to see if this works out.
Well, coming up on the podcast, we'll have our interview segment with Sylvain Perrier of Mercatus, who discusses e-commerce execution of regional grocers and also the keys for regional grocers to get people to buy in to some of their e-commerce and omni-channel platforms. We'll also talk about takeaways from the Digital Food and Beverage Conference this week in Chicago. And after the interview, we'll be back with more grocery-related news. It seems as though nearly every week on this show we're discussing grocery industry giants like Walmart and Kroger, and specifically their omni-channel efforts, what they're doing to stay relevant in the digital realm. But what about regional grocers who may not have the size but are still a key component of the grocery retail landscape? throughout North America. Well, our guest today has helped many regional grocers fine-tune their online presence. Sylvain Perrier is the president and CEO of Mercatus, who has created digital solutions for the likes of Weis Markets, Winco, Tops, Piggly Wiggly, and in the Southeast, Grocers. Sylvain, welcome to the Retail Focus Podcast.
Thank you. Pleasure being here.
First, I wonder if you can kind of fill in the background a little bit, or maybe the basics of what it takes, particularly for a regional grocery retailer, to be relevant or successful, or make sure that they're reaching their customers, whether it be in the online space or the app-based space.
Yeah, it's really essentially around two key things that we've seen over the years. The first and foremost is having a very sound operational plan. And what I mean by having a sound operational plan is making sure that you fulfill accordingly to the promises that you make to your shoppers. So if you claim that you're going to be delivering or they're going to be picking up fresh produce, excellent cuts of meat, you need to make sure that the people that are doing that work inside the store or at a fulfillment center are well educated on those standards and are delivering accordingly. The second thing, and it really encompasses everything you do in a go-to-market strategy, is you need to properly market your solution, your ideas, and the benefits to the consumers. And that can be done through social media, in-store advertising, and traditional TV, radio, and print.
So one of the things you mentioned there, the first aspect of your answer to that question was the fulfillment side. And I want to go ahead and jump to that because I know in crafting these solutions for all the markets that we've talked about and even more stores beyond that, a main focus of Mercatus generally is on the fulfillment. And we can talk so much about how you're reaching customers, this, that, and the other thing. But at the same time, you have to be able to fulfill. You have to be able to come through on the promises. So what are some specific focuses that you have in that area that make things a little bit easier for the grocer to be able to implement and kind of reduce friction?
Yeah, we grew up the solution predominantly on the operation side, the Mercatus platform. And I can tell you that it's never been easy because the behaviors of consumers are as such that you will see certain markets where consumers will want delivery, consumers will want curbside pickup, other consumers will want the ability to go into the store. So we've had to really mature the platform to make sure to kind of go back and to be able to put the right tools in the hands of the individuals to be able to fulfill those promises.
And then on the other side of that, obviously you've got the customer portion, and you mentioned a lot of it is about not only marketing to the customer, but marketing some sort of a benefit for the customer. And in your experience as someone that's been involved with online grocery fulfillment now for quite some time and providing digital solutions to these retailers, what are the most notable benefits to the consumer that you see? And moreover, how can grocers properly market them to make sure and get those consumers using those type of products?
Yeah, I think more often than not, for all of us in this day and age, life gets in the way of everything. And I think it's compounded if you live in an urban center or if you have children and so on. Retailers want to make sure that they continue to service their customer base in the way that customers want to interact with them. So a lot of the benefits that are promoted out there from a retailer to consumer perspective is the ability to still enjoy the great food that you would normally get from spending an hour in the store doing your groceries. But now it's a lot easier because you can have it delivered, or you may choose to want to just swing by the store and just park on the side of the store and have someone put it in the back of your car or in the trunk of your car. So you're still getting that interaction with the brand and access to some amazing products, but it's less friction. It takes less time from your part, and you're able to spend that saved time with your family or with a loved one doing something else.
One thing that I think we've heard a lot of, particularly from independent grocers, not necessarily the larger regional grocers, but some of the independent grocers, is that they're concerned about maybe losing that in-person customer base, losing whether it be things like impulse spending in person or the ability to interact with the consumer. What's your response there based on just how much of this that you've implemented in terms of how much this can benefit their business versus something that they see might be hurting overall share of wallet?
Yeah, I think if you take the approach that share of wallet is critical and is very important, I think that's the first thing. I always educate our customers, make sure you own every interaction with your shoppers, regardless of the fulfillment solution you choose, whether it's through a third-party service, whether it's any other food-based technology that's out there trying to capture share of wallet. You need to own that relationship from your customer from the moment they put an order to fulfillment. I think that the second thing that I do recommend to our customers is to really make sure they follow through in those interactions that they do have with their customers. And if you choose not to do something, which is not the right option, rest assured your closest competitor across the street is likely doing something or going to do something that will steal that share of wallet from you. In this day and age, and this is a very important statistic, the recent report that was released by the Food Marketing Institute called the Trends Report, and I believe it was in the first quarter of 2018, had some interesting numbers, is that 25% of consumers occasionally interact with an online grocery seller. Now that's up 10% from 2016. What's more important than that number is 15% of consumers exclusively interact with an online grocery seller. That's fairly significant because really what it means is we've achieved a near tipping point in the space, meaning that there is no turning back. There is but no choice to cross the chasm and for retailers to learn how to compete in the space.
As far as competing in this space, I know you've worked on a first-hand basis with a lot of different retailers, something that we've talked about already. You've implemented processes for a lot of different retailers, and something that you mentioned initially was that it's going to be a different implementation for every single retailer. We were talking a few weeks ago to data firm Cardlytics discussing how often it takes 5 to 6 times to interact with a digital grocery platform before it becomes habitual. Based on your experiences, what can grocers do in particular to make sure they get people to that 5th or 6th use of that online platform?
Yeah, that's an interesting statistic. Recently with one of our customers, those numbers, I would say the conversion was a lot faster, which was really astonishing to say the least. And basket growth in terms of online sales versus in-store was through the roof. Again, was very shocking. What I found more often than not, what really creates that stickiness and that conversion early on is really good content. So let me give you an example of good content. So Cinco de Mayo or something to do with some sort of festival around avocados. And as opposed to just putting up avocados on the website to say, hey, they're on sale, X dollars per pound, please click here, add it to your cart. So you may create an engaging piece of content that says, avocado, they're really good for your health. Here's how they benefit you. Here's things you can do with avocados, and click here to add them to your cart. Again, it's engaging content that teaches the consumer maybe what to do, how to pick, and how much they're priced. And it enables conversion that much faster, that much easier. And so if you start to adopt this whole idea of conversion or content that enables conversion across your .com or your mobile application, it's much more enriching. The second thing I would add to that, I've seen a lot of retailers today at the top end of an e-commerce project to bring in a separate merchandising team, which is typically only done when you crest over certain millions of dollars of online sales. But what we're finding when you have a merchandising team that is engaged at the beginning of a project is they start to understand, okay, here's the makeup of consumers coming to the website. Here's what we anticipate. Here's what they like. So on. This is based on loyalty data. Let's start making sure that these products, along with this information, is available on the website. And also, let's maximize our margins in making sure the products we sell online, actually cover our fulfillment costs from the human capital perspective as well from the equipment perspective, but also grow share of wallet that much faster for us, the retailer.
Some great points there, specifically with online merchandising, which is something I think a lot of regional grocers tend to overlook. Again, our guest, if you've just joined us, Sylvain Perrier, is the president and CEO of Mercatus, talking to us about online grocery solutions. Now, you mentioned great content in your response to the previous question, and one of the things that I noticed specifically about your platform, you got a lot of optionality there, but something that stuck out to me was this aspect of product options and bundles that kind of folds into that content aspect. I was wondering if you could kind of discuss those at a further length and walk our audience through how those type of features work.
Yeah, absolutely. That whole aspect of our platform came out of years of work with our friends at Price Chopper and specifically Tom Riley. And what we want is to make it that much easier for a retailer to put two things: a product with a series of options or a collection/bundle of products together with options. So an example could be you put up for sale a sheet cake and you may layer in a bunch of options. So the filling, so the flavor, the icing color, the decorations. You may also want to layer in additional items, which could be the plates, the hats, the forks, the spoons, and the knives, and so on. Again, those are options and add-ons of products. And the strength of just being able to do that for a prep side of the business is pretty impactful. The other side is, for example, if it's Thanksgiving and you want to put up a Thanksgiving dinner. So turkey, size of the turkey or the amount of meat that you want, and all your associated sides. So it could be the buns, and the buns could be whole wheat or they could be white. The type of gravy that you want, sides of vegetables and the types of vegetables you want. And the flexibility that we built in is twofold. One is any of those options or add-ons can be free or priced separately. If any given store that has this available runs out of one option, the retailer doesn't have to remove the entire product for the entire chain. You could simply say, for example, and this is a real world example, we had this happen. One of our retailers ran out of turkeys, and within 3 hours, they got a new shipment of turkeys. Well, it turns out that all the turkeys were spoiled because the cooling system on the delivery truck had failed. The driver never noticed. So there was 3 stores affected. So those 3 store managers logged into the platform and simply said, hey, we no longer have turkey meals available for these 3 stores. Now, it's unfortunate, but luckily the technology was as such that it didn't penalize the entire chain. And again, that's just an example of the flexibility of our technology.
And on the other side of that, nothing worse than promising consumers turkey dinners and not being able to deliver on that in the e-commerce realm. One thing I wanted to touch on now that we're kind of winding down, you have a podcast of your own. It's actually on the Mercatus website. You can check it out at mercatus.com. But your latest podcast was discussing digital grocers and the ADA, or the Americans with Disabilities Act. And this is something we've talked about a lot on the show during the history of the podcast in terms of brick and mortar. But I was wondering if you could kind of expand upon some of those ideas you covered in that particular podcast, particularly as it pertains to some of the web content accessibility guidelines that have been updated.
Yeah, absolutely. And I appreciate you mentioning ADA. It is such an important topic, and it is one that is overlooked in the industry, not just of grocery retail, but I think in technology in general. As a technologist, I don't sit around, and I can't remember a day and age where I would sit around with my coworkers and my peers in the space, and we'd say, okay, next user interface we design, we need to make sure people that are blind need to be able to use this technology. So what we've come to realize, we have a large aging population, and people with disabilities, regardless of what they may be, have to be able to use the technology that we create. They want to interact with the retailers and the brands that they favor. And so now we're taking the necessary measures of achieving a certification, not just Mercatus, but our technologies, in making sure that what we build and what we put out to market actually supports those individuals. And the laws are as such today that we're dealing with, it's called WCAG 2.0 level AA, which is the standard. And the reason for that standard is there's a recent case that an individual won in a Florida court, and it will quickly permeate across the country as being the de facto standard. WCAG 2.1 recently came out. It's going through ratification at this juncture, and I'm sure it will bring forward to market a series of more concrete standards that technologists will be able to kind of point to and say, okay, so this is a lot clearer for us. We know what we need to build towards to make sure the technology we're putting out there to market is fully compliant.
Good stuff. Well, as we wrap it up here, we were talking before we came on the air, started recording. You're currently at the Digital Food and Beverage Conference in Chicago. You're there, we're not. So I was wondering if you could kind of give us and our audience a few of the takeaways from the conference over the last few hours.
Absolutely. It's an interesting show because they're predominantly attended by CPGs, and the CPGs are actually much like the grocery retailers trying to figure this out. The key takeaways are CPGs really want to start sharing data with retailers and vice versa to be able to solve the problem and understand how to properly tackle e-commerce, but also take it a step further in being able to leverage consumer behavior to deliver the right item, the right product into their hands. Delivery is on the tip of everyone's tongue. We're actually hearing delivery, although it's really great, it's also about curbside and equally about click and collect. And this third thing that everyone's really talking about is this whole notion and emergence of robotics and how could robots potentially be used in a distribution center environment to be able to kind of lower cost of being able to deliver a really comprehensive e-commerce program.
All right. Well, thank you so much for joining us, Sylvain. We appreciate the conversation, appreciate the insights from the conference in Chicago, and we look forward to Mercatus's future development here. We'll keep an eye on it.
Perfect. Thank you so much.
Well, in our interview, we talked about regional grocers, and one particular regional grocer recently announced a partnership to provide last-mile services to their customer base. We're talking here about Hy-Vee, which is a regional grocer largely in the Midwest and the upper Midwest. Hy-Vee, for those who may not be well acquainted, they're a 245-store chain with locations in 8 total states. They don't get talked about a lot when you talk about the national grocery scene, but they are a fairly large grocer. We'll talk about that in a second. When you look at their footprint, there is overlap with some other regional outlets. Their footprint stretches south to Kansas and Missouri, and then north to Minnesota, Wisconsin, and the Dakotas. Regional competitors do include Meijer and Cub Foods, the latter of which, interestingly enough, Hy-Vee is actually taking over a Minnesota location from this fall. As Cub Foods closed in a location, Hy-Vee moving in. Now, according to the balance, Hy-Vee is the 35th largest grocer in the world. They're the 9th largest in the U.S. by sales. For reference here, they have reported sales of $10 billion yearly, or at least from last year. They are an employee-owned company, although they're not as public with their information as another employee-owned outlet in Publix is. But this $10 billion puts them a little bit larger than Winco. If you're familiar with them on the West Coast, Winco came in with sales of $6.5 billion last year, or Giant Eagle on the East Coast, which came in with sales a little over $9 billion in 2016. So that just kind of puts it in perspective in terms of where Hy-Vee exists in this grocery marketplace. And Leighton, at one point earlier in the decade, Hy-Vee was really bullish on building out this larger store footprint, stores over 100,000 square feet with restaurants and general merchandise. But lately, that hasn't really been the case for them.
Yeah, there's been 2 prevailing strategies in the world of supermarkets. One is to have these huge centers where you can have apparel selections, you can have restaurants within the supermarket, and really be able to demo all of the products that you sell and offer those in different restaurant settings. Whole Foods does this. Other restaurants do this, such as Kroger. In November of last year, however, Mark Hamstra of Supermarket News reported that they were actually easing up on this strategy, looking instead to open smaller format stores in urban areas. Additionally, they curbed their in-store juice bar concept for all of their new builds. Not only was this suspected to be in response to the consumers of the future, as CEO Randy Edeker said at that time, but there was substantial thought among onlookers that they were actually looking to reallocate some of their capital towards digital platforms as well. We look at this partnership, and rather than joining up with an exclusive service, Hy-Vee is actually partnering with two. Both Instacart and Shipt will now be used to help fulfilling orders at the store chain. This answers some of our long-term questions, at least somewhat, about how bullish Shipt is going to be seeking new clients to serve after the Target acquisition. It is especially interesting in this circumstance as Target competes directly with Hy-Vee in most of Hy-Vee's markets, and Hy-Vee's larger store concept with clothing and home essentials have actually opened in Target's backyard in the Twin Cities area. We've discussed in the long ago past on this podcast about Hy-Vee's rollout of their Aisles online service. Hy-Vee has been one of the few grocers to actually attempt regional online grocery fulfillment centers rather than relying exclusively on stores and store employees to fulfill orders, like you would see at actually Kroger with their ClickList program. Prior to this partnership announcement, Hy-Vee used other delivery options, including internal staff. It appears as though some of the existing options will continue to be offered to customers through the Aisles online platform. One major difference existing between the Aisles online delivery offers and from Shipt and Instacart is that Shipt and Instacart will host Hy-Vee products on their own apps. If customers enjoy the existing Aisles online delivery program, there will be no need to switch.
So this is in addition to their existing Aisles online delivery process, at least it is for right now. However, where this helps is if customers are already used to using Shipt or Instacart for retailers outside of Hy-Vee and already have the app or membership or regularly visit their sites. There was, however, a slight lack of detail from the company as it pertains to the eventual scale of the rollout. They did release short-term numbers for the rollout, though. Hy-Vee's CIO, Matt Ludwig, insinuated but didn't say outright that the rollout would be chain-wide, but as we've seen with other regional grocers, it may be difficult for Hy-Vee to establish Shipt and Instacart services at all of their stores. As we'll talk about in a second, they do have some stores in more rural areas in Iowa, Missouri, and the like, areas that aren't really covered by Shipt or Instacart and may not have an interest in being covered by Shipt and Instacart. But Hy-Vee did spell out specific markets that would have the Instacart and Shipt services by September. In fact, there are 25 total markets that will be covered by this rollout from this July, starting here in a couple of days, in fact, all the way through the end of September. Now, as far as the impacts for Shipt and Instacart, well, it adds a significant grocery retailer to each portfolio. We talked about Hy-Vee being a $10 billion retailer in terms of revenue every year. And some analysts said Instacart might be hurting slightly after the Amazon takeover of Whole Foods, but we see that here they don't seem to be that bad off. And in fact, Hy-Vee has about as many locations as Whole Foods and their revenue in the same territory as Whole Foods overall. Instacart is in 240 markets, by the way, in the U.S., Shipt in 150 markets. Between the two, based on my back-of-the-napkin work, they appear to cover areas with about 85 to 90% of Hy-Vee locations already. What I mean by that is Shipt and Instacart are already in metro areas where about 90% of the Hy-Vee locations are. There are some outlying Hy-Vee locations, the rural locations, and looking at some of the markets uncovered by this partnership brokered by Shipt, Instacart, and Hy-Vee, they're pretty small. Like Albany, Missouri, for example, they're a town of 1,730. They have a Hy-Vee that's fairly small, around 20,000 square feet. It won't be covered by this partnership. It is covered by some of Hy-Vee's other services, though. But all of Hy-Vee's markets that they're in that are above 50,000 residents appear to be covered by this partnership, which is absolutely crucial for all parties involved, and it should bring a little bit of a measure of extra convenience for these customers. Not sure the top line growth that will be brokered by this particular deal, but still can't fault Hy-Vee for looking outside the company and outside the organization for delivery solutions, especially if it eases the burden of internal delivery solutions that they've got within their own company.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, where each Leighton and I take a look ahead at one story we're keeping an eye on over the next week or the next month, and we begin with Leighton.
My looking ahead has to do with a story that we were going to cover on the podcast, but all of the details came out a little bit too late to include in our main earnings portion. Skechers came out on Thursday, and then on Friday, the stock ended up plunging around 21% because of the results. The company missed in earnings and top-line revenue. This nosedive was attributed to how the company is spending more money and where exactly all that money is going. They reported earnings per share of 29 cents this quarter, down from 38 cents last year and below the 41 cents per share that the analyst consensus estimates had brought forth. Global same-store sales did increase 4.5%, but that also was below guidance. Sales rose only $5 million year over year. That's a bad sign for the company. And as one analyst from Wells Fargo said, we no longer have confidence in the earnings trajectory for Skechers. Trent, I was once a long-term shareholder for this company, but I let go of the shares around $36 a share this year, and I just didn't have a good feeling about how the rest of the year was looking. And the reason for that, my thesis, wasn't that complex. It was pretty much in line with what this analyst said. I just didn't see an opportunity for top-line growth to exceed expectations, especially here domestically. They have a lot of global partnerships, especially in China, but the company just has not maintained steady, consistent traction in domestic markets. And despite what management has said on the call, by saying that they're really bullish on the international sales side of things, I think they have to get it right in all of their markets, or else at least focus a little bit more on all of their markets, because people are going to keep asking about America's sales. And I think this is one thing that the company is going to have to identify in the quarters to come. Other analysts ended up downgrading the stock, and now if you look, Trent, the stock price is right around $26 a share. So at a fairly low point for the 52-week trailing side of things. A lot of interesting news coming by the way of Skechers, something to keep an eye on for the future. Perhaps it could rebound again up to around $40 a share or even higher, but it's all dependent on management and how they deal with all the analyst skepticism.
Well, news came out this last week that Walmart had filed for a patent that would enable them to potentially listen in on conversations between cashiers and customers. Now, it's said to evaluate potentially whether workers were greeting customers or whether they were greeting customers properly, but some people are a little bit concerned that this patent would allow Walmart to also listen in on the customers and gauge their own feeling. Now, based on anecdotal evidence, there are a lot of people that I've come across that, as it is, don't like the fact that Walmart records customers while at the self-checkout. And I feel as though if this were to continue kind of making its way towards the front end, that Walmart may eventually chase off some customers. I get the idea that you want all of your cashiers to follow company protocol and that type of thing, but usually that's what front-end supervisors are for. And Walmart, after all, just reinvented the front-end supervisor position and some of their customer service positions on the front end. That's what those newfangled yellow vests are for in stores. But I'm anxious to see how exactly they implement this and whether or not they'll be warning customers that they're implementing this type of technology and how they're able to use this technology above and beyond just picking up analytics on their cashiers, but also picking up analytics on their customers to maybe gauge customer sentiment or temperament when they're interacting at the front end. Well, that'll do it for us on the Retail Focus podcast. For Leighton, I'm Trent saying so long until next week. We'll be back with another full slate of retail news.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.